Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. So, what is velocity banking? All it is a debt payoff strategy where you quote terminate your debt with the help of a line of credit. And before we get started, I'm just going to tell you something. It's like a little mini confession. Um, as a YouTuber, the hardest part of coming up with these videos is not the actual content itself because it's all in my brain, right? You know what the biggest challenge is? Figuring out different ways to say the same thing over and over again. So sometimes what I do is I take things from my childhood and I say, "Whoa, that's really cool," and then figure out how to incorporate it into the topic at hand, which is velocity banking. I don't know why. All of a sudden, I was thinking about Arnold Schwarzenegger, The Terminator, 1984. That was such a cool movie. It was a scary movie too. Like the first Terminator is a really freaky and scary movie, and I remember that scene. You remember that scene where like he looks at the phone book? I know the phone book, right? He looks at the phone book and he knocks on Sarah Connor's door. He's like, "Sarah Connor," and she's like, "Yes," and they blasts out that shotgun. Oh man, that was really memorable. I feel like movies these days aren't that memorable, but yeah, why am I even talking about this? All right, because we're gonna terminate our debt. So, but the whole point of this is that I just take something random and then that I liked, and then I try to relate it to the topic at hand. So that's what we're gonna do today. We're gonna terminate our debt. That's the goal. Velocity banking. So, what is velocity banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit. So there's only two things you need to get started. Number one is a budget. So you have your income, expenses, you have your leftover savings, and then what you have is an expense breakdown. So in your expense breakdown, you list every single debt that you have, every single debt. And then in the last line item, you have your general expenses that are not part of your debt. Okay, general life expenses. So this will always be there, but everything else we want to make to go to zero so we can increase our cash flow. And even with the same income, same expenses, right? We're going to do something crazy. Okay. And if you just kind of there's another line item here, but let's ignore that for now. But if we take a look at this and you showed this to the average person, like, hey, what would be better, saving $82 or saving zero, right? The average person would freak out because they feel like conditioned that they need to save money. And really, velocity banking is like not saving money rebranded, like not saving money 2.0, right? That's how we quote terminate our debt. And I don't know why I put this in quotes. I feel like Dr. Evil quote. Actually, let me type in Dr. Evil. Dr. Evil quotes. Y'all remember Dr. Evil where he puts things in quotes? We're going to terminate our debt, Scotty. It's been a long time since I watched Austin Powers. It's kind of a shame they stopped that one after the third one. I don't know if they'll ever bring it back, but I kind of feel weird that they're bringing back random things like the Naked Gun, and then they made a fourth Beverly Hills Cop. That that was okay, but it was not really that memorable. All right, so let's go ahead and get started. And so what's the point here? What are we trying to do is by not saving money with the help of something called the line of credit, we can increase this thing called the cash flow even though we're not saving money just by simply redirecting our flow of income, right? And so if you take a look here, right? So this is going to freak people out. You show people your checking account and let's say you get paid, they like to see a good your checking account filled with lots and lots of money. And that's okay if you don't have debt, but if you do have debt, that might be a problem, right? I that's a no bueno for me. But some people get freaked out. Even the bank gets freaked out about this, right? Because you ever try to like refinance or apply for a mortgage and they say, well, we want some, cash reserves. And they're like, I'm not going to do that. Right. Right. So that's what we're going to do here today. Velocity banking, not save money. And we're also going to need something called the line of credit. And so, what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. So, think of it as like a more flexible credit card, even though a credit card is technically a line of credit, right? And so, you might be asking, where do we get these lines of credit? And I'll just show you right here. This is my $280,000 home equity line of credit. $280,000. So what does that mean? It means I could go to a bank's website, click a button, and then they'll just dump up to $280,000 into my checking account at a 7.5% interest rate. And I actually have over $594,000 in lines of credit, personal credit cards, business credit cards, random personal line of credit, random, another personal line of credit, business credit card, home equity line of credit. Oh my goodness. And I'll tell you how I get all this credit, right? This is going to be the secret that might blow your mind. And the secret is banks don't lend money to people who need it. Banks don't lend money to people who need it. And so if you understand that, then you'll be easily able to get the money. But the problem is that, we wait to get into the situation and then figure out how do we get money, right? How do we get money? That's the worst time to get money, right? Because, it's kind of like crashing your car without auto insurance, and then you're asking yourself, "How do I get auto insurance?" It's like, you should have gotten the auto insurance before you started driving, right? But that's why people think of credit cards and lines of credit wrong. So, the difference here is with the average American velocity banker, it's like what's your main operating account? As the average American, it's a checking account. So you pay for things out of your checking account, and then you just leave the rest over, I'm sorry, you leave the rest in your checking account, whereas velocity banking, you just dump everything into your line of credit. Okay. And let's assume that we did have access to $120,000 line of credit, free and clear, right? This is like you had the insurance policy before you crashed the car. Now, even if you were going to do this in real life, you probably would have free and clear, but let's just assume we did have free and clear, right? So let's 27, 30, 50. And if we sum this up, right, because we have the balances right here, that's $107,000 in credit cards. Now, what if you move that $107,000 of the credit cards into the line of credit? What happened to these payments? Zero, zero, zero. Oh my goodness. Folks, do you see this income increasing? It's not, and the expenses are the same, but we just shuffled them around, right? And let me go ahead and hide this, right? Because you see this, right? $82 of savings. Everybody will tell you we need to make more money to get out of this hole, right? We need to make more money. But by simply shuffling some of our expenses, we literally went from $82 to 3,000, and let me dramatically zoom in. $3,528.87. We literally went from here to here, right? It's not like a multiple of 3. What's 3,500 divided by 8? That's like, I don't know. If I could do math, that would be like somewhere between 30 and 40, is it not? Actually, let me do Excel. Let me let me help. Excel will help me do the math, right? So that's a multiple of 43. Okay. So we increased this number by about 43 times, 44 times. Mind blown. Okay. I don't know about you, but my mind is blown, right? 43. 43. And we didn't make more money because you see this number, it's still the same. Now, the final step is you put your entire paycheck, your entire $8,000 into the line of credit, making your checking account balance zero. And then once you need to pay for your expenses, you take it out of the line of credit. And then after every single month, the balance of the line of credit will go down by $3,500 and some change, right? And so let's go ahead and do the math. So I'm going to do this I2 plus 1, and then G2 plus H2 minus our cash flow, which is 3528.87. And then what we do is we take the average daily balance, right? The average daily balance, and then we multiply it by the interest rate, which is 0.08, and then we divide by 12, right? And then what we do is we copy and paste. Copy, you see that? Copy and paste, right? Paycheck in, expenses out, paycheck in, expenses out. Beautiful, beautiful. Man, that was so easy. And then 34 months, we paid it off. All right. 34 months. And now we just got to write down in our milestones what happened. 34 months, and we paid off 107K of debt. That was so easy, right? Like, I didn't make more money. Now, obviously, you should always want to make more money, but what I'm saying is that, hey, if you didn't make more money and you just simply had a line of credit, you'd be fine. Most people, they'd freak out about this. Like, woo, you got a lot of credit card debt and you have too many loans. Oh, and it's like, oh, if you just don't save money and you have a line of credit to make not saving money really easy for you, look how easy this is, right? Look how easy this is. All right. So now let's go ahead and do this part. Actually, let me reset this. All right, so here's what we do here. And so we take a look at our loan calculator right here. If we put in the current month, they'll tell us the current balance. And, if you don't know how this stuff works, basically we use something called the cash flow index to figure out which debts to pay off or move into the line of credit. See here, $9,000 for an auto loan, we get $386 back in our cash flow. If we pay back 30 grand, we get $424 in our cash flow. So we use something called the cash flow index. All it is a formula of the balance divided by the payment. And then, okay, and then we'll get back our cash flow. And the lower the number, the better, right? The lower the number, the better. So let me go ahead and sum this up and see. Whoopsie. Let's see. All right. So now, how much is this? We only want G2 and G3. So it's about 19 grand, right? So let me make this a little bit bigger. 19 grand. And then we move this 19 grand into the line of credit, and then we'll get about $800 back in our cash flow. So let's go ahead and do this. 18 grand, yada, 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 yada. Remember that from Seinfeld? Yada, yada, yada. Well, I yada, yada, yada with him, Jerry. All right. So we move that, and then guess what happens to our cash flow? These two auto loans are 0, 0. And then look at that. How do we go from 82 to 4,000? Mind blown, right? Mind blown. All right. So now 4310.93. And then I'm going to copy and paste. And then, right, I'm going to do this. And this is going to be 39 months. 39 months. 39 months. And then what is this? 107 plus 21 plus 22. That's 150K. Ooh, that's pretty sweet. 5 months to pay off 2 auto loans. And now we're going to go to, what was it? 39 months. All right, so 39, 39, and then we're at 29 grand. So let's move this into the line of credit for now, but I'm just going to go over again the nuances with loans that you probably did not learn from other places, right? So plus 29116. And then this is going to be 0. And then this is going to be 4,735. All right. So now this is going to be 4735.19. All right. So now 45 months, we paid off that student loan. Okay. And then how much was it? It's 190K. And then now we're left with the mortgage. So 100, 0, 45. Now I know a lot of people freak out. Like, how can you pay off a 30 or 3% mortgage with the 8% line of credit? That makes no sense. Okay. And yeah, it doesn't make any sense. It doesn't. And that's why I say this is a cult, right? I admit it. I'm a cult leader. So if you want to join my cult, click the Google form link below and you probably have to pay me 20 grand. So now, given now that's out of the way, we're just going to use an 8% line of credit to pay off the 3% loan. And so what's the reason for, let's say, still wanting to use a line of credit rather than paying your extra payments directly? Um, in an ideal world, I mean, you just probably put your extra payments. Now, if you think about the average person, right? Where is their mindset? Their mindset is that I need to save money, right? And if I put all of my money into the loan, then how do I get it back, right? And so what we're trying to do is prevent what we call the fragmentation of our income. Another way is to say it is to prevent the segregation of income. And the reason why we got here is because we segregated our income, right? And so, as an alternative, one of the things that you can do is just dump all of your money into the line of credit and move pieces of the loan into the line, right? And that interest rate, even though it has an effect, the rate that it's minimal when once you start doing the quote chunking method, which is moving a piece of the loan into the line of credit. Now, would I ever move this entire loan into the line of credit? I probably wouldn't. I probably would never do that, right? But I would, because why? The bigger the difference between the interest rate, right? And the line of credit, the interest rate of the loan and line of credit, and the higher this cash flow index number is. So what does that mean? I have to pay 275,000 just to get $1,200 back in my cash flow. You're gonna end up throwing up way more money in the table that you intended, right? So that's pretty much the reality of that. In fact, let me open up the Velocity Banking Calculator to demonstrate this. So give me one moment. All right, here we are with the Velocity Banking Calculator, where you just kind of type in the numbers and it's pretty much the same deal as the previous situation we did, but all I did was kind of like be a little bit lazy and then take off $200 from the income and the expenses. So let's just do this. It'll probably be exactly the same. And if it's not, I'm actually curious how the calculator is doing its thing. So 8,000 and then 2,000. Interesting. Did the interest become a little bit greater? Okay. All right. So, what's the point of this is that you don't, here's what I'm going to demonstrate. If you move the whole loan into a line, 3 to 8, look at this, $55,000 of interest. But if you just pay it off in small chunks, we'll just do $8,000 chunks. Look at that, 18 grand. Okay, 18 grand. All right. So now here's the crazy part. If you use a 30% credit card, that beats the moving the loan into a line. Isn't that crazy? So an 30% credit card will beat an 8% line of credit. 4.2 years. 4.2 years. And some will be asking, why would you use a credit card? Well, the best credit decision is not necessarily the best financial decision. So if the bank sees that you're making $8,000 swipes on your credit card, guess what happens? You might go from like a 10 grand limit to easily 20 or 30 grand limit. You know what I mean? They'll wanna increase your limit, especially if you're just using it and swiping it and paying it off pretty quickly. Ooh, that's gonna be sweet, right? So let me go ahead and change this back to 8%, 4.1 years, 4.1 years, and debt terminated. So the 45 by 12 plus 4.1, 4.1, so 7.85 years. And then the goal, we reached our goal, which is debt. What am I doing here? Debt terminated, right? We terminated the debt. All right. So that's it for today, folks. So let's go ahead and look at Terminator 1. Terminator 1. That is such a scary looking Arnold. Look at that. Look at that. That's crazy, right? Man. The future is here and it's not as crazy as one would have hoped. But who knows? Maybe in 2025 they've already developed a Skynet. And yeah, I mean, I use ChatGPT all the time. You know what I mean? All right. Well, that's it for today, folks. So have a great day, and I'll see you all in the next video.